Episode 576, Trading Justice Podcast, coming at you, sponsored by TackleTrading.com. Just an outstanding community. We put out a world-class newsletter this weekend that will catch you up on all of very dynamic market action. And at Tackle Trading, in 1 week from this coming Monday, which is, we're recording this on a Sunday, 8 days from now, we have an option success training. You hear us talk, Matt, a lot in the podcast, in our halftime shows at Tackle Trading, about technical analysis, about options. That option success training is designed to provide a foundational level of education so you can become an expert eventually in these areas. You've done a great job with that option success training, Matt. Talk a little bit about it. I know you teach it. It's a fantastic course for beginners, a fantastic course for individuals looking for a refresher. Talk about it a little bit.
Yeah, the Option Success Training is a 2-day course we do for our pro members of Tackle Trading. We do it about every couple months. Haven't done one in a few months here. We've been focused on other things. But in terms of the Option Success Training, we got a new one coming up on May 6th and 7th at 6 p.m. Eastern Standard Time. If you want to register for that, it's for the pro membership. So if you're not a pro, very easily can sign up for a free 15-day trial and get access to some of the better education, quite frankly, in the entire marketplace. Our education is above reproach. There's no doubt about that. We're a 5-star rated educational company on Trustpilot, is a secondary rankings agency, and we're very proud of that. We're very proud of the education that we have. And if you are looking for amazing education, a kickstart to learning how to trade or invest, the Option Success Training is a start here function. There's no doubt about that. People that have learned how to trade along the way, that need a refresher, this is a great class for that. People that need to learn the basics of technical analysis, trends, patterns, support, resistance, but also getting into options. And Coach Gino, who teaches it with me, does such a wonderful, wonderful job teaching the basics of options. And so if you are looking for an amazing course, we got one coming up in about a week from now, May 6th and 7th. If you want to register for that class, it is free for pro members. We do charge for non-pro members. And if you want to get enrolled, email us at team@tackletrading.com. If you're a pro member and you're listening to this podcast this week, we will send you an email later on this week so that you can register as well. But definitely get excited about it. It's a great course. And in about 5 hours, you can learn a tremendous amount about how to navigate the financial world.
Yeah, no, and you know, you've been doing such a stellar job during this last couple of weeks of volatility, Matt, in guiding the tackle trading community through the technicals of it, right? It's very easy because last week when we were doing this podcast, we were coming into the podcast, we had 6 days down, right? That hadn't happened in a while, and there were a lot of headlines that we kind of made fun of last week on the podcast, talking about new bear market, this and that. And we're like, let's hold our horses, hold our horses. We got some foundational support levels that we need to see how they react to, and a basic understanding of technical analysis, right, through the option success training, through the tackle trading education, can help one understand what's actually going on out there beyond the price action. Because not all days of price action are created equal. Some are more important than others. And we saw that this week, coming down to the 20 weekly moving average, some of the battles. So get educated. Education is amazing. It really is. It makes the world better. It just does. It just does. But Matt, there's a lot of places to start. Let's talk, since we were talking technicals. Let's talk about where we're at in this volatility, right? It was a week where bulls had total control on the intraday charts. Not a huge lift off necessarily, a couple percent, certainly reprieve. But Matt, it was amazing just how in control they felt this week. What did you see this week from a technical perspective?
Well, I think it's easy to point to the final conclusion of the week and say the bulls were in control, but it took a a really, really, really good report out of Google to change that conversation. Quite frankly, the bears were starting to kind of assert their will a little bit after the upward movement in price. But Google's report on Thursday just threw a whole bunch of cold water on any bearish analysis out there, and that's kind of what we've been waiting on is catalyst from an earnings perspective to shift the conversation away from the macro side of the equation to more of the individual side of the equation, and that's kind of what we did see a little bit this week. But I'm going to go back a little bit because when you're looking at this week, and the bulls reasserting their control this week in the market, I don't think that was unexpected, quite frankly. In fact, when you go back 2 weeks ago, we downgraded the market 2 weeks ago into net neutrality right there at the positive 40 ranking. And the reason we downgraded the market into it, right as the market was starting to show its volatility 2 weeks ago, is because we expected the end conclusion of that increase in volatility to be a downward movement in price. And so we felt, collectively as coaches at Tackle Trading, we just felt like it was, we needed to downgrade the market from bullish territory because we had started to see the violations of trend analysis. We had seen shifting volatility at the top end of the trend. And let's just call a spade a spade. When we see slowing momentum followed by shifting volatility, those are two big technical signs that are going to stand out to us. And those two signs are how we call reversal analysis at the top end of a trend. And so I felt we were a little bit in front of, from a rankings perspective, in front of the volatility. And then a week ago, we kept the ranking right there at 40. This week, despite with the big downward movement in price a week ago, we still kept it right there at 40. When the market recovered last week, we still kept the S&P ranked right there at 40 this week. And so despite the big down last week and despite the big up this week, we haven't really budged the rankings at Tackle Trading. And newer traders would see the big downward movement in price and be like, oh my goodness, the end of the world is coming. Why isn't Tackle downgrading aggressively here? And it's because this is a technical saga. At this point, it's a technical story. And when you're going through the technical stories, you're not going to significantly upgrade and downgrade based on the development of patterns. You're going to allow those patterns to develop because we will not know. And like I talked about in this podcast last week, and like we've talked about at Tackle Trading in our pro membership throughout the last 2 weeks, when you're going through these market corrections, you don't know necessarily if it's a pullback, a standard market correction, or something a little bit worse, i.e. the ultimate bearish marketplace. But there's key levels in that saga that you're going to want to track. And we call those potential catalysts. And the potential catalyst can come out there from a leading indicator perspective, i.e. your earnings results or your economic reports, those degrees of leading indicators. But you can also have lagging indicators also perform as catalyst out there as well. And in these environments, you got to be looking at both of them. It's not just one or the other, but the combination of both of them that is important. The combination of assessing where the market is from a support perspective, and two, is there going to be some degree of catalyst come out to really spark that support level and start working out a little bit more. And when we wrote the newsletter 2 weeks ago or a week and a half ago, that was the two open questions, quite frankly, in the newsletter. Was 5K going to hold? It did this week. And B, was it going to hold based on what degree of catalyst out there? And so you got your technical catalyst lagging indicators. The 20 weekly moving average at 5K would be an indicator of support, a potential indication where you could see some bottom. And so our philosophy at Tackle was simply, all right, we're going through, standard bullish retracement analysis on the weekly chart, which is the market correction. And the ultimate question we're trying to answer is this just a pullback, meaning we've found support already at 5K, or is this something greater than just a pullback? And you really can't determine that. Even with the upward movement in price this week, you really can't determine that because there's really, and I talked about this in the newsletter this weekend, so I'm hoping all the pro members really caught that. but there's really two patterns that could develop here that give you the indication that this volatility is over, or this is just the first stage of volatility. And quite frankly, we don't know yet. We don't know yet, not until we see whether or not we're going to be talking about a bear stop out pattern this week, and we're talking about the violation of resistance, or whether we're talking about a potential double bottom around 5K coming up this week. Both of those two are very much in the purview this week, whether or not we get that ultimate, V-shaped type of rally where the market goes up, bases at a resistance level, and then, obviously breaks out of that resistance level and continues to go, or whether we're going to see something come right back down to that 5K level and give us more of that traditional W. I would love to come onto this pod right now and basically say, all right, now we buy. But that's not how reversals play out. There's not a singular moment in time.
And nor is that why people listen to us, right?
No.
Our regular listeners listen to us because we have a pretty good track record and we're straight shooters. Let's just call it what it is.
We're gonna listen. We're gonna let the patterns do the talking here, because in this environment, and I say it all the time, I'll say it here, I'm gonna say it until the cows come home. We're not here to catch a trade. There's a lot of good trades this week, but we're here.
I want to catch about 17 trades is what I want to do.
Or you want one trade to go 14 days and not 14 minutes. And that's kind of what it feels like.
I have zero interest in trying to scalp this market. I'd rather place a few larger bets. Absolutely.
Well, and honestly, if we're going to bear stop out a V-shaped rally here, that's a good trading setup, but that is not a good pickup setup from anything.
Nope.
Longer term. Anything longer term's got to be through proper development at the low point, and you could certainly get that here. You could easily get a double bottom here at 5K. I do like the developing deeper retracement here. That's usually a pretty good sign that the bulls are here to participate a little bit more than just
and that's what I think that's a great call out. And in examining, Friday afternoons after the markets close, I have a coaching session with a day trading student. And we meet every Friday and we go over intraday charts. And we were both amazed at the intraday price action, how bulls just won where they were supposed to and one where they weren't supposed to. They had and the result of that leads to a little bit deeper retracement, right? A little bit deeper retracement.
The only day this week where I would disagree with you is on Wednesday, when the patterns you saw this week on the bulls, and again, this is not unexpected given the fact that we were expecting 5K to give a nice little battle test, but you had those big upward movements in price followed by consolidation. That's what you're talking about. Big up, consolidate, big up, consolidate, big up, consolidate. On Wednesday, that started to turn. As you formed that bear flag in the market and you started to turn around, that started changing and you started seeing additional volatility to the downside, similar to that of what we were seeing on Sunday, Monday, and Tuesday of this week. But Mark, right on Thursday, right after the bell closed, you had Google come out, and Google changed that entire conversation. All of a sudden,
but the market was rallying on Thursday because Google came out after hours. The market was rallying into Google's report.
Well, that's because I think Google released some information and got them excited a little bit. But the immediacy happened immediately in the futures market right after the market closed. I think the market was up 20 points on the close of Thursday. The market was going up. So. And again, the two open questions last week, and let's keep our eye on the prize here. The two open questions last week was 5K going to hold, and was it going to hold based on a catalyst? 5K held, and it held based on a catalyst. And the catalyst, in my estimation, was earnings. Meta sold off, but they had a positive earnings. Google's earnings were just standout. A 30-cent beat on EPS, beat on revenue, beat on every segment. $70 billion stock buyback program, the first dividend in the history of Google. You get better than that, but it's called NVIDIA a year ago. That was a really, really, really good report. And even Meta's selling off on earnings. I didn't take that as an overall negative, quite frankly. I took that as an overreaction by the market. I think the market got Meta wrong last week. And so we'll see what happens with Meta here. But I do think ultimately those two questions got answered last week. And when you're moving on into this week, I'm not sure they're different questions. It's now just a matter of what patterns do we get here? Do we get the reemergence of volatility due to Apple or Amazon on the earnings front? We are in a short-term bearish retracement, although a deeper bearish retracement right now in the marketplace. And number two, does that volatility hold at 5K? If it does, we got a nice little W formation. So we're going through pattern development here at the low point. I call it short-term reversal analysis against the backdrop of a really good bullish uptrend. And there are scenarios, Mark, where we've seen the conclusion of the volatility. There are scenarios that can play out that way this week. And so I do think last week was the ultimate decision week for the marketplace, but I would like to see that ultimate decision get a little bit of confirmation here this week.
Yeah, no, and busy weekend. We'll talk about that in a few minutes, Matt. You know, in many ways, this last week was a micro over macro, right? Because the catalysts were on the micro level. Let's focus. Where are we on the overall? You know, big cap tech bringing it home, as we've been accustomed to for a long time. What about earnings as a whole? Where are we earnings as a whole right now?
When you're looking at the overall earnings landscape here, let's just take a look at the EPS beats, the blended growth beats, or rate, and the revenue beat. When you're looking at last week specifically, and I write about this in the newsletter every single week during earnings season, I give these updates, and so definitely go be a pro member so you can get the entire update. But I look at three basic numbers here: EPS beats, revenue beats, and then the blended growth number. The blended growth number is very important to how I see the improving or deterioration condition of earnings season itself. We saw a couple, most companies came out.
It's hard to fib on that blended growth number, isn't it?
It's very difficult to lie on the blended growth number. That is accurate. The lies are typically told in the projections of the blended growth number, and then it has to come to the truth as the companies actually report. And that's what I love about the blended growth number is you get a lot of what they think they're going to do, but then the blended growth is based on what they actually print out there from an earnings perspective. And so EPS beats went up a little bit last week from 74% to 77%. That does match the 5-year average right at 77% beat rate. The revenue beat rate did increase to 60, but again, the 5-year average is 69 from the very beginning of earnings. I've said we're having a revenue problem in this earnings season. We are having a little bit of a revenue problem, but we are seeing improving conditions out of that. The big impact last week was on the blended growth side of the equation. Now, blended growth had contracted from March 31st at 3.4% down to the first 2 weeks of earning down to about 0.5%. Now, you might look at that and be like, oh, earnings season must be going really, really bad. No. What transpired in the first 2 weeks of earnings season was you had a couple significant downgrades in expectations coming out of Bristol Myers and Biogen out of the healthcare space. That had an oversized impact on the blended growth because we didn't yet see the actual numbers coming out of Meta and Google and, you know, all these other big dogs reporting. We had 150 companies report last week. On net, we saw the blended growth improve from 0.50 to 3.50, which now puts it above where we started this earnings season, right at that 3.4% expectation. That is a really good bump up. I fully expect that to continue to bump up. And the reason I do is as we're moving a little bit further in earnings season, the magnitude of the EPS beats are starting to increase, and they're now matching their 5-year average at 8.5, 8.6%. And so most companies reporting last week were, I'd say the average last week was probably over 10%, which certainly helped the magnitude of the EPS beats. And that's most likely going to continue, as it typically does continue throughout earnings season as we go through, you know, shockingly, what is actually a bigger earnings week this week. I don't think it's the same catalyst type names this week, although you do get some really, really important names from an earnings perspective this week. If you were going to ask me what's the most important company reporting earnings this week, I would actually say it's Amazon.
Yeah, I'd say it's Amazon too.
I think because I think, Apple, for example, I wrote about it in the newsletter, but Apple, it's kind of baked into Apple's earnings that they're not going to produce this quarter. That like there's not a lot of expectation.
It's like Tesla, right? It's
Very
like,
similar. Great call
I
out.
mean, you knew Tesla's struggling right now as far as, compared to where they had been in recent years. Why known that the China sales slow down in both companies, to be honest. I mean, we know what the issues are. And so, a bad report of Apple is kind of like, kind of expected it, right?
Yeah, I think that's a good call out on Tesla because do we get the same response out of Apple that we got out of Tesla? A bad report, but an upward movement in price. It wouldn't shock me, quite frankly. I wasn't shocked on Tesla. I thought Tesla had a bad report, but I wasn't shocked it went up. Sometimes earnings can be a little bit freakish from a reporting perspective versus what the stock does on that day, where the stock is in relationship to support and resistance, where it is in relationship to its trends and its patterns, what's volatility doing, what's the market doing, where's the market at in relationship to support and resistance. Is it a good day to report earnings? Is it a bad day to report earnings? There's a lot of secondary factors that go in when you're looking at how a company performs on its actual earnings day. But yeah, I think that's a good call out on Apple. Amazon, I got as number one. I actually have AMD as a more important report this week than even Apple. Don't get me wrong, the $3 billion behemoth of Apple is going to have something to say about the market this week. I'm not trying to pour cold water on their impact.
But I think AMD is the most fascinating story in the market this
especially
week.
with AMD at the low point. Like
even if it doesn't have the effect, right? I think it's the most fascinating story.
Yeah, I do too. And there's a lot of other really compelling earnings stories this week. But I would say if there's 3 earnings reports that are head and shoulders above the other earnings reports this week, I would put Amazon 1, AMD 2. Both of those report after the market on Thursday. And then I would put Apple as a third. Sorry, Apple, but you're going to get the third spot in importance going into that. And that's after the market on Thursday. After Thursday, or I don't want to say we're done with earnings after Thursday, but we're done with the catalysts, the themes, we'll have a good 70% of the companies reporting earnings. And so there's nothing new to catch after you get through this week. But this is a big week with a tremendous amount of companies reporting earnings.
Give me a letter grade. Where are we on earnings? Where are we on our earnings?
I mean, my goodness.
As a total, right? Google gets A's. We know this. Well, where are we as a whole? It's
a very average performance so far. I mean, the magnitude of the beats is matching the 5-year average. The 70.
So B minus,
matching the 5-year average. I don't think you can. I don't think you can give
it a B minus too harsh.
The markets are punishing misses more than the.
Oh yeah, they are.
And so I would say C plus. I don't think I could give it a B letter grade because if you're thinking average performance, I'd say B.
Yeah, and, and if you look at, because Friday's a big party day, right? In the main indexes, RSP, the equal weighted, didn't go anywhere.
Yeah. Well, yeah, because it was a mag week. It's a macro week. It was all the stories were on Tesla and Meta and Google and all big cap, large moat type companies. And so, yeah, it's not surprising that on a week there, a week where you're expecting big dogs to talk, where if the market goes bullish, the big dogs lead the charge. And so I don't think that's abnormal. The question will be, if this is a low, do they constantly outperform from this environment, or does the areas getting carried, do they outperform? I think as you come out of this,
I think that will depend on the macro.
Yes, but I do think as we come out of this volatility of the market, I do think you're looking more at those large moat type companies.
I absolutely 1,000% agree.
And then you would anything else out there. If you're looking at the market right now and you're saying, hey, stable, get a little bit more stable, start working out some of the issues in the market a little bit. I don't think as you come through reversal analysis in correction type environments, with an understanding of, let's go get aggressive. I think you look large moats here.
Let's go leverage up on ARC
No. I think you're looking at blue chips and large moat companies as we come out of this.
Yeah, I think so too. And that's because the macro is unsettling. Let's talk about the macro here for a second. But so C plus, is that what I got you at?
Yeah, I would say a C plus is probably where my head's at. It has not been an earnings season to knock your socks off in any capacity. It's been average performance, and again, if it's average performance, I got it very similar to last quarter, quite frankly.
With the huge difference of the price reaction on misses from last quarter.
Well, yes, because if you reported earnings last quarter, you got to bump up. If you
reported, if you had the audacity to actually file an earnings report,
you got in earnings season last quarter, you got to bump up. But this season, this season is one of you got to beat, and if you beat, you typically do stabilize. If not, we are starting to see a little bit more of the gap up on beats. Thank Google for that one, I think. But in general, the market is punishing misses far more than it's rewarding beats right now. And that's even more than on average, which on average, the market typically does punish misses more than it rewards beats. But we are seeing more than average on that side of the equation. So yeah, I C plus, but it's starting to improve. I got a little bit of a better understanding and after we're getting through the big dogs and the generals. And outside the generals, Mark, if you'll mind for just 1 second, there were 4 companies that in different spaces that I also felt stood out last week as well. Hess, out of the energy side of the equation, was just an absolute knockout. They were by far, in my estimation, the best EPS beat last week. GE Aerospace, that is. They beat by 26%. They were a standout both from a technical perspective and a fundamental perspective. Newmont Mining, and I wrote about this a lot in the newsletter, and definitely check that out if you're interested in commodity plays in the catch-up play. But Newmont Mining had a significant beat, and they stand out. AEM confirmed that in the gold side. They beat EPS by 57%. General Motors was a standout as well. So you had it wasn't just the generals last week. In fact, I would say these 4 companies were better than what we saw out of the generals. And so, yeah, it's getting better out there, but I would still put it as a net average performance.
Yeah, okay. Just fascinating price action. And you're with me. I think we're both on the same page. We wrote about this in the newsletter a couple weeks ago. Large moats likely play here. This is an S&P over RSP environment. And that's particularly if the macro becomes a little more uncertain, right? And we had
that as abnormal coming from low points like that.
No,
generals and big companies lead. Wasn't that kind of the expectation coming out of this?
I think the psychology after 2022 and late 2021 is still in the market. 2021 was a great year for bulls. It was not a great year for your average stock. A lot of small caps, a lot of ARK, a lot of memes, a lot of DraftKings, which is a quality company.
You say a lot about that last year in the market too.
That happened in 2021. 2022 was a butchery everywhere. Last year, you saw this for long stretches. I think this is part of the market psychology where the least bit of turmoil, let's go to what we can trust, right? Yeah. Let's go to what we believe. Let's go where we know we have, diamond hands, which is large moats.
Large moats, yeah.
Which is large moats. So I think that psychology is deeply embedded in the market right now. And for your average stock, for your RSP, to not repeat what happened from last year where you had just long stretches of underperformance, we're probably going to have to see the macro cooperate, Matt. And it's an interesting macro backdrop. Last week, we had economic data for the first time in a while come in on the soft side. Now, whether that matters at all will depend on the next string of economic data, right? If the next string of economic data comes in strong, nobody going to remember any of that. And then we had inflationary data while coming in with expectations did rise on the core PCE following, well, we've chronicled the inflationary saga pretty good here on this Trading Justice podcast. But you're probably going to need some macro to start getting people excited, or else it's going to be a stock pickers market, investors pickers market.
Well,
What did you make out of the economic data last week?
to get people most excited about the market, we got to stop having a interest rate conversation. Whenever we have an interest rate conversation and on the top side, market's going to get a little bit spooked. So on the macro side, you would have to see some changes on the inflationary conversation as seen through the lens of the central bank. But on the economic side this week, I felt we had an interesting GDP report on Thursday. The Atlanta Now GDP has been extremely accurate in the last year. And to see this sizable miss on the advanced GDP side, which is the first in the the sandwich of three different reports we get in the GDP, the advanced, the preliminary, and then the final. I was a little surprised, honestly. I was not expecting a sizable miss on the GDP side. In fact, I wasn't even thinking GDP was going to be a conversation this week, given the fact that the Atlanta Now GDP has been so stinking accurate. But here we are. It came in at 1.6, and when I first saw the number, I can just give you my initial take on the number. When I first saw the 1.6, my initial take was that's got to be seen as positive for the marketplace. And I know that seems crazy to normal Americans out there, because when you think about it, why would that be good for the stock market when you think about it from their purview, right? A little bit of good news is bad news or bad news is good news goes a long way when you're talking about what the central bank is going to do. And that's how you see some of this bad news is good news is through the lens of the central bank, not through the lens of, is this good for the U.S. economy? But if the economy contracts, well, guess what? Typically, it's going to contract with that, both the market as well as the inflationary concerns. And so I initially saw that I took it as a positive for the central bank. But then when you go down into the numbers of the GDP mark, you got the personal consumption rate within the GDP landscape. And that came in at 3.4%. And that's the inflationary side of the GDP. So you got inflation coming in CPI report, core CPI report, core inflationary data out of the PCE report, all between 3 and 4% right now. You got personal consumption right at 3.4% right now. You got GDP going at 1.6% right now. That's called stagflation.
That was the fact. You can tell the audience the first thing out of the first thing you thought was this. The first thing out of your mouth to me was that looks like stagflation.
Well, it is, and I think it's here for a while. I do. I think it's here for a while. I don't feel the inflationary saga is going to come to a quick conclusion in any capacity. Opening up the floodgates of monetary policy recently has certainly not helped that. But even the Fed is, in my estimation, has accepted that they're not going to be hitting their targets. And most of Wall Street is expanding their inflationary 2% targets of when the central bank is going to achieve it. So even if the Fed achieves their 2% inflationary target by 2026 at this point, I do not believe they're going to do that, mind you. But even if they do, we're going to be growing at 2% underneath the rate of inflation for the next 4 to 5 years. I don't think that's an outlandish statement to say. I do believe inflation will outpace GDP growth over the next few years. And so that's economic stagflation. That's what it is. You call a spade. And the only time we went through economic stagflation like this is in the 1970s. And we don't got to go long to break down that analogy of the 1970s to right now. There's a lot of similarities. So I think it's just proof. I think it's more proof in the pudding that we are going through stagflation. And I do think more and more people are going to accept that type of language as what we're going into. And for people that are like, oh, stagflation can't be worse than inflation. You're right. If inflation's going up at 3% and the economy's contracting at 3%, that's a really nasty situation. But it's also not good when you can't grow. And that's what stagflation is. However hard you work, you can never get above what the rate of inflation is. And that has a debilitating mentality on the American consumer. Over time, it does. And so I took it as that was a little bit of proof of stagflation. I am concerned that regardless of the powers that be do here, that we could be heading into a prolonged stagflation conversation. And as we look back from a historical lens, I do think you could go back to about a year ago to accept the starting point of that stagflation conversation. And so I think it was further data of that. But again, I don't think that's new information for us at Tackle Trading or in this Trading Justice podcast. We've been having this conversation for a long time. In fact, I believe it was a year and a half ago I talked about the potential of stagflation coming out of this environment, and a year and a half later, here we are.
Yeah, no, and if stagflation becomes a narrative in the market, and
we're going to love commodities for a long time.
You're gonna, that is a commodity-friendly backdrop.
The entire 70s were about commodities,
and you've heard that analysis, which we have discussed several times. Well, you started to see a lot more of that recently.
Well, and also, I don't believe stagflation necessarily has to be a bearish form of argument for the markets either. I think if one thing has been proven, that the market can grow earnings higher than either the GDP or the inflationary mandate. When you're looking at growth, in fact, I believe Warren Buffett once made a quote that if earnings growth lasts above 6%, I think this is all the way back in like the late 1990s. And I'm paraphrasing, so I apologize if I get it wrong, but I believe that the genesis of the conversation was regarding, can EPS maintain above a certain growth over a certain time period? And Buffett basically said that if EPS growth stays above 6%, for a prolonged time period, that it would be such a unique situation that just never happens. 24 years later, we've grown far more than 6% yearly from an EPS perspective. And so I'm not necessarily sold on the ultimate conclusion of what the market would do in stagflation, although I am sold on one key component of stagflation, and that is the commodities, and specifically energy, and maybe along the lines of copper and precious metals, will outperform the general market in that condition.
Yeah, no, I mean, the thing about it is that you're going to have companies in a stagflationary environment. I think the commodities is our strongest call in that, something we do particularly well. If that is the narrative over a while, it's hard to see everything type rally, environment. It's really easy to see individual stocks.
What would it take for an all or everything rally like we had from November to March?
I don't know if that's in.
No, I didn't ask that. I said, what would it take?
All right.
I don't think it's in the cards either, but there's always a path for that.
Inflation falling, the Goldilocks scenario coming.
Inflation falling, earnings stays top, and the Fed gets to cut in June.
Yeah, like that's what
scenario, right?
Yeah, that was the scenario that the market was rallying on. So
earnings continues to improve throughout the back half of earnings season. The Fed gets
or even if it maintains, if you give it a B minus, C plus at the end of earnings season, right? Where you're like, yeah,
stay at 3.4% on blended growth, I'm not maintaining. Like that has to improve. But let's say it does on average.
Okay, let's say it does. Let's say it does.
And let's say we get through earnings season, and it's because we saw improving conditions this week. We saw improving conditions last week. So we are going through an improving condition. Let's say that continues throughout earnings season, but I don't expect it to continue that much. We're right around the 5-year averages on pretty much everything besides revenue. Let's say you get a couple prints on inflation and labor that go the Fed way, right? However you want to categorize that, but they go the Fed's way. You could see that Goldilocks scenario coming up.
Yeah, inflation has to be like,
but it has to be on the macro side, right?
Yes, it has to.
It's not going to be just because one company reports earnings like, ooh, catalyst. No, that'll spark the space, it'll spark the industry, but it's not going to spark the market. Macro moments take macro analysis, right?
Yep.
So I'm with you, but don't you kind of feel like the base case is there will be some leadership here, but separation where we start having a little bit of a breadth conversation here?
Yeah, no, I think get used to the headlines 3, 4, 5 months from now, where you get these dumb bears, and they're just terrible, awful analysts and creatures, where their sole argument is the market sucks and is a big casino because market breadth sucks. And that is terrible analysis, because maybe the market breadth is terrible because
there's some companies that are so good that they carry the rest of the market. That's a bad
argument. Like, listen, because it's not like an unreasonable to say, oh, in this environment, Google, who has a moat the size of the galaxy, right, is going to do really well no matter what the market condition is.
Or Nvidia with the moat the size of 2.
Whereas your average chemical company in a macro stagflation environment, who knows, right? And people, I mean, that's not that's a logical environment. Right.
In times of uncertainty, we're not in 1993 any longer.
Yeah. So you could have a market breadth situation. Yeah, you could have a market breadth situation that is purely logical, that is not irrational, right? And I think that's where you're headed. I think that's where you're headed.
I do too. But in those environments of the past, it was the tech trade that worked, and it was the semiconductors that led. And what's interesting here, Mark, is tech is going through a very similar situation of the S&P 500 itself is. But on Friday, and this is going to be obvious given the fact that it was Google's report on Thursday night that kind of sparked this. So on Friday, you saw general massive outperformance on large moat stocks, big cap market stocks, so on and so forth. Last week, you saw a little bit of that same thing transpire. Now, obviously, I had a really good week last week, but Mark, Google had earnings, and they had a great earnings, but Nvidia outperformed them last week.
Yeah.
You're starting to see money come and flow into those aggressive assets.
Yeah. A sneaky thing that most people missed in the price action. So Meta has their earnings Wednesday after the bell, right?
Yeah. They did Wednesday, yeah.
Yeah, so market gaps down, all kinds of concerns. You know what opened up on Thursday morning? Semiconductors.
And semis, yeah.
You know what? Because if the big concern out of the big companies is they're spending too much on AI, semis picked up on that after hours and actually gapped up.
I want to be clear. I think whoever said Meta was spending too much money was making stuff up.
Well, of course, right.
We want Meta to spend on R&D and specifically AI. And yeah, I get it. The other metaverse type stuff that Zuck has been bleeding. But Mark, Zuck had bled the exact same amount of money on the metaverse last quarter, as he did the year before and the year before, when we were doing nothing but talking about the year of efficiency. There was not additional money spent there. There wasn't. They lose like $3 billion a quarter every quarter. That's what Meta does. And so I was just shocked by that being used as the excuse, because I'm like, have you guys not been around Meta on this one? Like, and then there were some people complaining about, oh, Meta's spending money on AI. Meta's behind the AI conversation. They should spend R&D.
Yeah, no, I think Meta's earning reaction is one of those earnings reactions you see sometimes when the market's is a little bit volatile, right? Because it don't make any sense.
Oh, I think people had made the decision to dump Meta going into the print.
They had made the decision, and then they were looking for reasons.
I know this seems shocking, but I don't think Meta going down this week had absolutely anything to do with the fundamental side of Meta.
No, it had nothing to do. This was because, you saw they had decided to dump stock. Caterpillar.
Well, frankly, the same thing can be said of Tesla on the top side this week. I don't think Tesla went up because they did anything on the fundamental side. that's not why earnings always goes up or down. It's just on a beat versus a miss. There's other context there, but yeah, we did see, semis start to take a charge. Now semis are coming from a low point, but we saw semis start to take a charge a little bit. The big dogs start to take a charge a little bit. It'll be interesting to see if they carry. But coming back to last week, GDP prints takeaway was stagflation. PCE, honestly, I was shocked that we didn't get more conversation out of the PCE report on Friday, but there was just not a lot there. Even myself in the halftime report, I kind of treated it as a little bit of a throwaway. It came in at 0.3. Expectation was
it did nothing to change the conversation.
It really didn't. It really didn't. It's almost like we have our opinion of inflation right now. We have our opinion, and I'm talking about general market of what the central bank's going to do. And until the CPI changes, and specifically CPI, we're just having that same conversation.
Yeah, no, it did nothing to change the conversation. So market's moving on to the next week. And Matt, we got an interesting one this week. Now, one of the things that you were spared of is Fed analysis up to this point, because they were all in their blackout period, so we didn't have to listen to any of them. But that will not be the case this week, Matt. Here we are 40 minutes into a podcast, and we're just bringing up the Fed meeting for the coming week. And I think there's a reason for that. That wasn't necessarily even planned on our part. And it's not that it's not important, right? Because markets can move. But what can Jay Powell really say, given the data this week, to change the narrative?
Not much this week.
And that's why we haven't brought it up. And it wasn't even planned on you and I's part that we wouldn't talk about the Fed to this point. Right.
98% of the market believes the Fed's going to do nothing this week. And I think that's about what we should talk about the Fed this week. A lot is weighing on the June-July meeting. There's no weight on the May meeting. Nobody's expecting them to do anything in May. They're going to have the same conversation. There's nothing happened in the data to change the conversation at all. And so I think we're just going to rinse and repeat the last 2 months in the May meeting. Does Powell indicate what they're planning on doing in June or July? Does the GDP miss last week influence that? Have they seen it?
And that is the one thing, just, as a little poker player, do you see a tell? Does he really highlight that this week?
He better not. Personal consumption was up 3.4%.
Yeah, but we know he wants to cut. That.
I get it, but like the only people that would not literally call Powell out on that are the people that don't ever even understand that there's a personal consumption inflation.
So basically every politician that is alive today.
Oh, yes, of course. But we don't listen to politicians when it comes to what the Fed should do, because they always speak whatever their personal book is politically. So I could care less about that. To me, I just don't feel like nothing's going to happen this week from a central bank perspective. 90% of the market does not expect any cut in June. Right now, 70% of the market doesn't expect a cut in July. And for the 30, 45, what do we got in September? We got 56% of the market expects a cut in September. I'm just going to tell you guys right now, if the Fed doesn't start cutting in July, they are not cutting in September. The election issue will be right around the corner.
Yeah, no, it's just that simple. And so, maybe something comes out that we can parse Powell's language.
Yeah, but don't you think the market's getting to the point where we just kind of think Powell's the boy who cried wolf? Like that's the entire market right now, just got Powell as the boy here. Given the fact that there was supposed to be 7-8 cuts coming into this year. Now we're talking about maybe 2 cuts. And my personal read is they shouldn't embrace a cut this year.
That's been the take for a while, but that doesn't mean they don't desperately want.
Oh, I think they desperately want one, but the data has not been supportive.
And 2 weeks ago, they headed into this past week, and they were basically saying, listen, we're going to have to see improving data or we can't cut. That's essentially what they were saying.
Well, and the improving data is they got their 1.6% improving data on GDP, but again, the secondary data was not supportive of them because again, everything got worse. When GDP goes to 1.6, but the inflationary pressures remain.
Now it will be one thing, Matt, if GDP shows a miss. It will be another thing if unemployment cracks, because then the Fed will cut, and they will cut quickly. And we got the unemployment report
Labor
on
gives
Friday.
up anything, they will take that inch and they will drive it a mile.
They will drive my let's say you had, and once again, it's forecasted that we added 243,000 jobs. If we only add 2,212, that's not labor cracking, right? It's softening, it's missing expectation. Maybe the economy's not as robust. I'm talking about cracking, right? We only added 17,000 jobs. That type of miss. Now, that's probably not going to happen this week.
I have a political joke right now that I can't tell, but I really, really, really want to. Really, really, really bad. Really. Maybe later. Yeah, I do think at the end of the day, the Fed wants to see but that's been the case for years here, Chucky. Yeah. If the Fed had their way, what's their Goldilocks moment? Their Goldilocks is a shallow recession with inflation getting fixed. That's Goldilocks
what they want.
Situation.
And that's what they want. And you go back to 2000.
I don't think that's the worst situation for America moving.
No, you go back to 2022. Jay Powell was very open about that. He wanted to take your money. He wanted you as an average American to go through pain because it would fix all of his problems. And it never happened.
It's a lot of problems. He's not wrong on that. I don't want to see people struggle either, but if you want to fix inflation, the best way and fastest way, I don't want to say the best way is to actually have some semblance of a rational monetary and fiscal policy.
That's not happening.
Best way, but that's not happening.
That's cute.
Yeah, I'm not even that doesn't even get put into the conversation anymore because it's never going to happen. And so the powers that be will not have a proper monetary or fiscal policy. The other second best way to fix inflation is to cause massive economic pain, because what happens to the purse strings is when we start going through recession language, consumers start contracting really much, money dries up, inflation comes down and contracts. That is a path, but I'll just say this. You can't hope for a shallow recession, because if you hope for bad things, they can get out of control really, really, really fast. And when you live in a world that is literally based on a house of cards from a fiscal and monetary policy, you might not want to get what you hope for sometimes on the downside, because it can spiral very quickly.
Yeah, no. And so listen, if you get a big miss on unemployment, because I think, this unemployment thing, this is a widely known in the market. If you ever get a sizable miss, that I think could cause an everything rally for a short period of time, because the cuts are coming. The cuts are coming. Now, you're probably not going to get one, but Friday's unemployment has beat 29 billion weeks in a row, right? So statistically very strange that one report could miss to the upside that many times in a row.
I don't think it's strange. I really don't.
Yeah.
I think there's one thing that a lot of people are not taking into account, and that's the amount of that's the immigration and how immigration is impacting the labor market reports. I do not think we were prepared to understand that metric in the last couple of years. And that has had a sizable impact on.
Yeah, that's getting some ink lately. Powell's talked about that a lot more lately too.
Yeah, well, that was kind of my joke. I was going to say, just shut down the border for 3 weeks. You'll get a few misses here. But then,
why can't you tell that joke? That's funny.
Because you know how people get on politics. They get all upset over absolutely everything.
That's funny. And you're not a funny man. But that was funny.
Great offense to that. Great offense.
You're a left brain nerd.
My humor is locked in right now. But no, I do think that context sometimes gets missed when we talk about the strength of the labor market numbers, because we've had historical immigration in the last 18 24 months as well. And the things we're doing on that side is putting them to work fairly quickly. And so that is offsetting some of the numbers. And I think that has kept the labor market up, unofficially higher than it typically would be in this environment.
Einstein wasn't very funny either. You know who else wasn't funny? Ayn Rand.
Dude,
She wasn't very funny.
Come on.
You read At Last Shrugged, there wasn't one funny line in that whole masterpiece. Not one. Like
which one?
Last Shrugged.
No.
Atlas Shrugged. The masterpiece from Ayn Rand. I read the thing multiple times. There's no funniness in it.
Oh, well, what are you talking about? The entire movie was funny.
Well, the movie was terrible, but that's
why it was funny. It was
like it wasn't. Well, it wasn't trying to be funny.
Okay, unofficial funny is actually funnier than actually.
It can be actually, like really terrible movies are actually.
By the way,
gems.
Book. If there's ever been a moment where a movie does not do the book justice, it is Atlas Shrugged.
Yeah, that doesn't even count as a movie.
The book is amazing. One of the best books I've ever read.
But needless to say, if unemployment report misses, we'll talk about it that will be the next podcast. If it ever misses big, but probably not going to miss big, right? I don't think they shut down the border, did they?
No, they did not.
They didn't fund the border either. I saw that in the recent thing either. So, yeah, not a big House Speaker fan. Not a big House Speaker fan. So, I want to go off on politics so freaking bad right now.
That's why I should have said the joke. That's why I should not have said the joke.
Because like all of a sudden, all of my
I broke it. I broke our streak.
All of my hard right tendencies are like just ready to erupt right now.
I got to be smarter than that. I apologize.
It's okay. It's okay. But we got we got Amazon, we got AMD, we got unemployment report, we got PAL. A sneaky one that's not on Forex Factory at 3 p.m. on Monday. The Treasury is having their quarterly refunding announcement. Now, I'm not going to bore you what that is, but it basically tells the markets how the Treasury is going to do their funding and how much funding. That has been a bullish event as Janet has given the market what she wants. So if you see yields falling 1 hour before the market closes, and if you see stocks rallying 1 hour before the market closes on Monday, well, bears might have some arguments, but bulls have a yelling. So
that's the truth.
Bulls have a yelling.
Bulls have the entire world of finance built for them, pretty much.
It's not a fair playing field.
It's not. But then you put Treasury Secretary Janet Yellen in that mix.
In an election year?
Oh, man.
Man.
So
if you see yields falling, and if yields fall, markets tend to rally. When you see big yields fall at one hour before the market closes on Monday, just be like, yeah, Yellen doing what Yellen does. Right? Even if I don't understand the quarterly refunding announcement.
Doesn't matter.
I understand Janet Yellen's really, really powerful.
I understand Janet.
I understand she's a player. She's a player. All right, Matt, listen, option success. We talked about it at the start of the podcast, but it's coming up. And, there's going to be a technical battle this week. You want to learn technicals. You want to follow along when we have really smart people like Matt talk about technicals, right? To understand concepts like support and resistance. And if you're not a pro member, sign up for a trial. You will be able to sneak in as a pro member by doing that and get the class for free. The way to cheat the system. Do it. It's worth your time. It's worth your attendance. A little bit of knowledge goes a long ways. But Matt, give us some final thoughts as we wrap up the podcast.
Yeah, didn't really talk a lot about gold today in the pod.
We could talk about consolidation patterns if you want.
What's happening here in gold, although I will tell you right now, I wrote about the catch-up trade in regards to energy and crude oil and gold miners in the Tackle Trading newsletter this week. If you want to learn about that, I wrote all about it, so definitely check that out in the newsletter. But that's really the only conversation that interests me on the gold side of the equation right now. It's a little bit of a general consolidation. We'll see what transpires here oil kind of going through the exact same thing. And this is the thing, when volatility hits the market, it really impacts all the asset classes very similar in the initial surges of volatility. And then what transpires next is you start to see a separation. And we really haven't started to see that separation yet. Gold broke
You
support.
got to keep them separated.
Broke support. Everything's running on a little bit of the same gasoline. But once again, that is not abnormal when you're going through increased volatility conditions and you go through a general macro moment in the marketplace. But as we go throughout earnings season, you're going to see that separate. And we saw the early stages of that last week with, the NASDAQ, specifically the semiconductors, Google and communications stepping up. You've seen healthcare start to take a step in the right direction, finance take a step in the right direction as well. And so in general, I would say improving conditions across the board last week in both the market, gold, crude, and a lot of other asset classes. But they're also going through short-term bearish retracements against a longer-term backdrop of uptrends. I think by the end of this week specifically, we'll have that understanding of exactly where the market needs to go. Because on gold, I would say that a little bit of the same thing that I would say on crude here needs a little bit of further development. S&P needs a little bit of further development. So just wanted to get a couple thoughts out there on the gold and the crude oil side of the equation. Bitcoin, we'll come back to you when you're not wide range neutrality, but that's pretty much the exact same conversation we've been having for the last month and a half or so on Bitcoin.
Were you ever into pop punk?
Not really. Not myself. I'm more of a rock guy, more of a Metallica guy, Megadeth. Give me a little bit of that type of stuff. Guns N' Roses, 80s, 90s hairband type stuff. That was kind of my thing.
I just got the Offspring running through my head now.
I like Offspring. I do.
Offspring's fun.
I can get down with a little bit of Offspring.
They still play. They passed through Salt Lake.
I like a lot of different genres, honestly. Like a lot of different genres. But if you were to give me one 5-year stretch, give me the late 70s. Like give me the late 70s.
I mean, because I love talking Bitcoin, but that chart is boring.
Yeah, I'd much rather have the music conversation, quite frankly, so appreciate that. With that said, guys, a couple things. Number one, if you're not a pro member of Tackle Train, become a pro member. Check out the Tackle Train newsletter. It will help you dial in the week that came at us, the week that's coming, the week that was, and the week that's coming at us. You will be more prepared for the market every single day by making that newsletter part of your routine on the weekend. That's number one. Number two, we got a new option success training coming up on the 6th and 7th. Coach Gino Poor and myself will be there teaching technical analysis and trading options. We'll have more information on how to sign up for the option success training this week. I'll have the link in the halftime report tomorrow. We'll also make sure that everybody gets an email this week so that you can sign up for that option success training at I want to say it's 6 p.m. Eastern Standard Time on May 6th and 7th. That's a week from this coming Monday. So definitely check that out as well. We have a lot of fun and you learn a tremendous amount in that option success training. Once again, day one's all about learning how to read technical analysis. Day two is all about learning the basics of trading options. And that will give you a proper educated foundation in technical analysis and trading options so that you can start doing this for yourself a little bit more effective and a little bit more efficient out there as well. With that said, hope to see you in that class and hope to see you in Tackle Trading. We always want to give a nice little word from our sponsor, Tackle Trading, in the podcast. If you love the podcast, make sure to give us a nice little iTunes review if you love the podcast. And if you want to give hit that like and share on YouTube. That's much appreciated as well. With that said, I hope everybody has a wonderful, wonderful week. And if you need anything from us at Tackle Trading, you can always hit us up at team@tackletrading.com or head over to tackletrading.com and sign up for a free trial membership. Or you can hit us up in our Tackle Trading Discord. A lot of different ways to communicate in the world of 2024, and we like to communicate in all of them. So with that said, have a wonderful week. Hopefully you guys have an amazing trading week, and we'll see you next week.
See you next week, everyone.